Good morning, everyone. Thanks for tuning in today. My name is David Weiss. I'm the Vice President for Finance at DuPage Foundation. On behalf of our Board of Trustees, Investment Committee, and staff, it's my pleasure to welcome you to the first of hopefully many webinars with our investment consultants and partners at Northern Trust. Today's webinar will focus on the Foundation's main investment portfolio at Northern Trust and a discussion on the current economy and future outlook. Before introducing today's participants, allow me to share a few housekeeping notes. Today's webinar is being recorded and will be made available after the program. With regard to questions, we invite you to submit them through the program utilizing the Q&A feature at the bottom of your Zoom window. We will address them during the segment near the end of the hour or as the content allows. If you have any specific questions about your fund at the Foundation or need additional information on today's content, feel free to contact us at the email address we will provide in the chat. I'd like to introduce our panelists. Today's speakers include our Northern Trust portfolio co-managers, Darius Gill, who is the National Practice Executive for Foundation and Institutional Advisors, and Marty Morris, a Senior Portfolio Manager with the same group. Also joining us today from Northern Trust is Dan Phillips, Director of Asset Allocation Strategy. And finally, monitoring the Q&A and chat, Matt Wilson, Accounting Associate here at DuPage Foundation. That said, Darius, Marty, and Dan, thank you for joining us today. The floor is all yours.
All right. Thank you, David. Good morning, everyone. I've got a little bit of a cold I'm battling, so if I'm a little worse, please bear with me. Luckily for you, Dan Phillips and Marty will be doing most of the talking today, so this shouldn't interfere too much. Once again, good morning and welcome to the first of what we hope will be an ongoing feature of these quarterly calls for the donors and investors of the DuPage Foundation. As David said, my name is Darius Gill, and I run the national practice for nonprofits at Northern Trust. One housekeeping note from our standpoint before we get going, I would encourage all of you to please, after we're done, reach out to your friends at the DuPage Foundation, give them feedback on the format, the topics. Again, we want to have this on a quarterly basis. We want to make sure we make good use of your time and are covering topics that are of interest to you. So if you provide that feedback, it'll help us do a better job for you in the future. The format today, I see the agenda up in front of you. I'll do a brief introduction on the firm and on our practice. Dan Phillips is going to spend about 20 minutes talking about the current state of the markets and the economy. And then Marty Morris will do a little bit of a deeper dive into the current portfolio and performance. And obviously, we will leave time for Q&A after both Dan's session and Marty's session. So please do, send in your questions as and when they come up. So in terms of who Northern Trust is, we are a local Chicago firm. We've been around since 1889, so we've been around for quite a while. We have, over that time, transitioned into a global investment firm. We currently have 25,000 partners across the globe. As you can see on the slide, we have a fairly substantial presence in the investment business. We custody over 16 trillion in assets for our clients around the globe. We manage over 1.6 trillion and have a pretty healthy and robust balance sheet. Now, as a firm, we actually have a very simple and what I would call a very focused structure. We do three things for our clients and three things only. We provide investment services to individuals and to institutions. We provide asset servicing to large institutional clients like large corporate pension plans, sovereign wealth funds, etc. And third, all we do is provide banking to the first two clients. That's it. Now, in terms of our practice itself, the Foundation and Institutional Advisors Group, we are a dedicated group set up to work exclusively with nonprofit and institutional clients, very much like the DuPage Foundation. It's a national practice. We have 62 partners spread out throughout the country. And what we do is provide OCIO services, which is industry jargon for essentially saying we manage money for our nonprofit clients. We act as the investment arm of our clients. That's the outsourced chief investment officer bit. And along with investments in custody, we also provide comprehensive value-added services, which I will touch on in a minute. And the clients we serve, again, very much like the DuPage Foundation, foundations, endowments, nonprofits of all shapes and sizes, ranging in size from a few million to over 2 billion. Now, the services that I talked about, investment management, obviously, that's what we do. We manage money, we custody the assets, but it's more than just that, right? It starts with working with your clients, understanding who they are, creating an investment policy statement that leads to a long-term strategy. Then we make tactical moves in the near term based on the environment we're in. We custody the assets, we move money, we accept gifts, monetize the gifts. We're a bank, so our clients who need bank accounts, lines of credit, we can provide that. And then finally, that fourth column, which is the value-added piece, is where I think we can differentiate ourselves from a lot of other firms in this business. So if you think about it, all nonprofits are not alike, right? So you have some nonprofits like the DuPage Foundation, they raise funds. They may need help with donor development. We can do that. They may need help with planned giving programs. We can provide that expertise. What about if you're a nonprofit that is really interested in aligning your investments with your mission along an ESG or an impact investing lens? Well, we can do that as well. So to wrap up, why would a nonprofit like the DuPage Foundation, want to partner with a Northern Trust? Again, we bring specific expertise in the nonprofit sector. We build customized solutions for our clients because every client has unique needs, unique liabilities. So you need a unique customized solution, nothing cookie cutter about it. We are very much a client-focused culture. And again, while we are a local firm, we have a global reach. We have global resources that we bring to bear for our clients. So as I get ready to transition to the heart of the presentation and turn over to Dan, Dan, this reminds me of the old Chinese saying, may you live in interesting times. And I would venture to say that this environment fits that. We are dealing with a pandemic that, depending on what part of the globe you're in, is ebbing or flowing. We've got that horrible invasion of Ukraine, which is devastating and ongoing, and has the very real possibility of spilling over into neighboring countries. We have rampant inflation in the U.S., which as recently as at the end of the year, we and many of our competitor firms were labeling as transitory, and it has proven to be anything but. So there's a whole host of issues for the markets and for investors to grapple with. So we're hoping in the next 20 minutes, you can help put some context around that for us and help us as investors understand what does this mean for the markets, for our portfolios, how should we be positioning portfolios, and finally, what can we expect from the markets and the portfolios in the coming years. So with that, Dan, I'll turn over to you.
All right, well, thanks, Darius. Just a quick sound check. Everyone hear me okay? I see nodding heads. Thank you for that. And then last question, am I able to advance the slides, Darius, or are you going to do that?
You should be able to advance them. Give it a try. If not, I can do it for you.
All right.
Or just tell me and I'll move them.
All right. Yeah, that might be better than watching me try to fumble around here. So yes, certainly we are putting to test the logic or wisdom of that Chinese proverb. I don't know how much more of interesting times I want to live in, but it is what it is. So what I thought I would do, and as Darius mentioned, is I'm going to lay out the current economic and financial market landscape. And then I'll get into some of our strategic themes long-term, and then finally get into our tactical asset allocation and the asset classes we have and why we have the asset classes that we have in the portfolio. So starting first and foremost on the slide you see in front of you, these are the purchasing manager indices. These are very watched data from our industry, our world, from investors as it relates to how the global economic environment is doing, as along with all of the individual regions. And what we like about this data is it's very real time. It comes out basically the first or second business day after month end, whereas GDP data takes, just to use this most recent quarter as an example, the quarter obviously ended at the end of March. We just got the first preliminary reading of GDP a week ago or so, and then it'll take them another 2 months to finalize that number. It's a lot of data. It's a lot of useful data for posterity, but for our purposes, really what we just want to know is if the economy is doing well or not. And purchasing manager indices give us that. Effectively, it's a very simple metric. It's reaching out to purchasing manager indices across all industries and ask them a question. Did you do more sales or less sales? Do you see more business or less business? And if they've been doing more business, that number is above 50. And if they're doing less business, that number is below 50. And so you can see here the fall in those purchasing manager indices during the pandemic, and then what was an extremely quick reversal, definitely thanks to a lot of fiscal stimulus, at least here in the US. Now, that led to what we're dealing with right now, which is or partially led to what we're dealing with right now, which is a lot of inflation. I'll come back to that in a second. But as it sits today, we have seen some moderation of the global growth story, but not much. We're still very much above 50 there, and as long as we're above 50, the growth story is intact. The other thing I'd mention about this chart, though, is if you look on the far left at how close all of those metrics were versus where we sit today and how dispersed they are. And this may be a sign of the individual regions. This may be a sign to come if we do start moving away from globalization to more deglobalized economies, which means that they may have more of their own economic cycles as opposed to the sort of uniform economic cycle that we've seen for most of the last 20 years by virtue of all of the globalization that did occur. It brought to us the phrase, when the US catches a cold, the rest of the world catches pneumonia. Going forward, that might change. And again, especially because of the deglobalization, where individual regions and economies may have their own cycles. And we get the question a lot, what does that mean for if we deglobalize the economy, should we deglobalize our portfolios? And the answer is maybe somewhat counterintuitively, but you want more globalization. You get more diversification benefits if all the economies in the world aren't as in sync as they've been in the past. And so right now, and as we'll get to, the US is our favorite region. But that won't be always the case. Things will change, and again, having that global starting point is, in our opinion, really important. Notably there, if you look, the last thing I'll mention on this slide is that China line there. So China has been struggling. They have indirect consequences from the war in Ukraine, and that it comes in the form of more eyes on them with respect to what they may or may not want to do with Taiwan. So there's a geopolitical element there. They've also been dealing with a regulatory crackdown over the last couple of years, which investors haven't been all that thrilled with because of the fact that cash flows from companies that you own aren't worth much if you don't get to keep those cash flows. And that's what some of the concern is with respect to some of the regulations out of China. And then most recently, and still going on, is their zero COVID policy combined with less effective vaccines. The vaccines used within China are much less efficacious than those in the Western world, which has led to a real spike in COVID and in their restrictions because of that, again, because of their zero COVID policy. So that really is explaining a lot of why China is so low on that chart. But beyond China, the other economies of the world are doing quite well, albeit with the risk of the war hanging over the heads of many economies, some more than others. So for instance, Europe is much more at risk of a recession than we are. They're about 40% prior to the war of their natural gas came from Russia, a lot of their oil. And then even for Europe, but broadly for the world, actually, the agriculture element there, a lot of wheat and corn comes from Ukraine and Russia, as does fertilizer. So there's a lot of impacts here. We talk a lot about how geopolitical events aren't something to worry about unless they impact the fundamentals. Well, this is an example of a geopolitical event that could, and in fact has been impacting those fundamentals. So Europe is at more of a risk of recession, but within the US, we actually don't have recession in our 1-year outlook. We think for a few reasons. One, we do not think the Fed will end up raising rates as much as many may think. We saw a little bit of that yesterday with Jerome Powell and some of the wording he had around how many further rate hikes we may see. Now, the markets have reversed a lot of yesterday's action so far today, if you've been looking at the markets. But we take some of that to heart, that what we think he was doing is trying to ratchet down expectations a bit, saying that 75 basis point hikes, for instance, are not something that they're actively considering. So that's one reason to think that the US may be able to come out of this without a recession. Secondly, balance sheets are really healthy. Consumers have a lot of money. They still have a lot of money, even though they've been spending a lot of it on goods. Now they're transitioning that more to a better mix of goods and services. By the way, that should help a little bit with inflation. And finally, we just don't have the same exposure to foreign oil as, say, Europe does. So we certainly have some. We've been cutting. We were energy independent for a year or two there. We kind of slipped out of that, but we're still fairly energy independent. So that makes the U.S. look a little bit better than other regions right now. And you'll see that when we get to our asset allocation. Going on to the next slide, and I'll go through some of these a little bit more quickly. This one I won't touch at all. This is just the numbers behind what you saw on the previous page, and we can actually skip over this one as well. But with respect to global interest rates, and with respect to the Fed, by virtue of what the Fed has been doing over the last few months and others, the UK actually beat us to the punch of starting to raise rates. They had a little bit more inflation than we did. And even Europe is looking at potentially getting out of their zero interest rate policy in the next year or two. And as a result of that, the yield curves, and this is basically all the numbers behind the yield curves of all a number of developed countries, which you can see there are listed down on the left. And then looking at the interest rates across 1, 10, 2, 3 years, all the way out to 30 years, and color coded, right? So red being negative rates, and then green being anything above 3. And if you looked at this chart, say 2 years ago or so, there was what we always referred to as a huge red blob. That red blob has gotten a lot smaller, but back even as recently as a year ago, that red blob extended all the way up to basically everything other than the US, Canada, and Australia, and all the way out in some cases to 10 years. So where we sit today is interest rates have come up quite a bit, actually, where there's not a lot of negative interest rates out there in the world anymore. And in one sense, that might be considered bad because it means less liquidity in the market, less accommodation. But on the other side, and maybe needs to take maybe a little bit more sympathy for this view, is that it's good. It's getting back to something more normal, where up is up again and down is down, and people are no longer paying governments for the privilege of holding their money for them. So we actually see this as a positive, and we see the Fed doing what they're doing and able to do what they're doing as somewhat of a positive over the intermediate term, say 2 to 3 years, that they are in fact able to get out of negative interest rates. Now, clearly over the last quarter, we've seen markets down, but before that, the year before that, we saw markets, and the 2 years before that, we saw markets up materially. I think there's a slide in here that gets to the whole idea of corrections and how often they happen. So we'll come back to that in a few slides. But the point here on this slide is that certainly interest rates are moving higher. Now, we don't think that if you look at the 10-year US Treasury there, this shows it at 2.34%. This is a little bit dated. Apologies for that. It's as of last month end. It's more at like 3% today. We think we may be getting to a high level mark on interest rates. We are, and as you'll see in our asset allocation, we've been underweight investment grade fixed income materially because of the fear of higher rates, but we are looking and have started to reduce that underweight. If we go on to the next slide here. So this takes those numbers and puts it back into yield curve form. And I won't go through all of these, but on the upper left there is the US curve. And what it is the current curve, which is in green, the year out of what the markets think the curve will look like in a year's time, and what they think it'll look like in 5 years' time. And one reason why we think the Fed won't be able to raise its rates as much as the markets think is because of how flat that yield curve, and in fact, inverted yield curve, at least in the market expectations in 1 year, how inverted it gets there. We don't think the Fed wants to invert the yield curve if they can help it. That will depend on inflation and how quickly it comes down. But we do think, in fact, we are at a high level mark, high water mark for inflation, and that we will start to see it come down. The question, of course, is how quickly. We think there's a reasonable chance that if the Fed can arrest what is the concerns over a price wage spiral where prices go higher, therefore wages go higher, therefore prices go higher, et cetera, if they can cut that out, then they might actually be in a situation where they'll be pausing. And actually, even the markets believe that by 2024, the Fed will actually will be forced to start cutting rates, We think what will happen is they won't have to raise as much, so they don't perhaps won't have to start cutting in 2024. And the reason why we think that, one, is because we do believe inflation will start coming down, and then two, back to this chart, they don't want to invert, we don't think they would want to invert the yield curve if they can help it. And so if long-term rates are so anchored, which they are, look at the 10-year over where they sit today versus expectations for a year from now, 5 years from now. If that's true, if rates stay at this 3% level or even lower, then again, I think it'll be hard for the Fed to raise rates too materially. So moving on to the next slide, just real quickly on global monetary policy. And it's not just the Fed funds rate, of course, it is what they're doing with the balance sheet as well. And if you look in the top right chart there, you can see the major central banks and how many assets they've purchased over recent years. The green line is the Fed. You can see QE3 there very clearly on the left. It petered out at $4.5 trillion in balance sheet size, and then they started actually cutting that prior to going into the pandemic, which of course caused QE4, and now we're off to the races again. And most recently, the Fed has tapered their purchases and is actually going to start cutting in a few months' time. So that green line is going to flatline out and start to go lower. Why I bring this up is we've gotten a lot of questions around, wow, if the Fed starts to bring out all this liquidity, are we in store for a lot more volatility? And there is a good case to be made for that. But what I would also ask that people keep in mind is if you look back in 2017 there, December 2017, the Fed had stopped raising or increasing their balance sheet, actually started to cut it. 2017, I think the slide might be in here. If it's not, we certainly get it to you, was the least volatile year in recorded history. We only had 3 days that year where the markets were either up more than 1% or down more than 1%. And that compares against, usually we have at least double digits on both sides. So it's always good to keep that perspective that oftentimes when there's a lot more going on with the Fed's very important, don't get me wrong, but there's a lot of other things going on as well that we need to keep in mind. And then top left there, just where the major central banks sit, as I mentioned, Bank of England already started, the Fed is on their tails. Moving to the next chart here. So this is the Fed funds, the famous FOMC dot plot. And there's a bunch of lines and dots here. I'll quickly describe what you see. The dots are all the Fed members and what their expectations are at the end of the coming years, and then what the long-term neutral rate should be. The dotted line at the bottom was where the Fed median committee members' expectation was for rate hikes. And you can see how much lower it was then versus where it is now, which is that darker green line. Now, the Fed does this every quarter, so they didn't release a new one yesterday with that meeting, but they will in June. And then that teal line is the Fed funds futures as it relates to the market expectations. So it's interesting that the markets are actually believing that the Fed will have to raise more than they think. That's generally not the case. And again, we think for the reasons I described earlier, that neither the Fed or the markets will be right, that will come in a little bit below that. We see certainly another 50 next meeting and probably another 50 after that, but at which point they may be at a point where if inflation's coming down, they can start to potentially pause and reassess what's going on. That's a base case for us, but certainly there's a risk case that Fed fund rates continue to go higher. Moving on to the next slide here, real quickly on credit spreads. Fairly well behaved. It's another reason not to get too pessimistic on the markets versus say what you saw during the pandemic or certainly during the financial crisis. And in fact, high yield spreads are at pretty low levels. And that prompts some to say, well, then why do I want to take on that risk? What I would say there is that average over the last, call it 30 years there, is a little bit artificial in the sense that the index has moved much more of a higher quality. So it stands to reason if the index is higher level, then that average should be, the equilibrium, if you will, long-term average should be lower as well, because it's a different index than it was before. And in fact, in this market, and as you'll see when we get to our asset allocation page, we actually like high yield right now. We like the 6 to 7% we can get there. We like it more than investment grade because we think credit risk is less of a risk than what we'd call term risk or interest rate risk. And so that's, even though rates are below long-term levels, we think structurally it makes sense, and actually tactically it makes sense because defaults are very low right now. Distress situations are very low. Interest coverage ratios are very high. And so high yield is something that we think is a place, especially going forward, that we may be able to hide in a little bit when perhaps equities are going through volatility and rates are going through volatility as well. And then moving on to the next slide here, real quick on earnings here. Point to make here is that no, we're not going to have the same earnings growth that we saw last year. But if you look at the 2022 and 2023 numbers, I'll take 10%, close to 10%. And these numbers, as you can see on the left, have the revisions have actually been going higher, especially in the US throughout the year. And so with the US economy, even if we don't think we'll have a recession, but even if we had a shallow one, there is a good chance that we've got enough resiliency in the US economy, in the US stock market, that is, the companies within, that won't be maybe as big of an impact as perhaps historically. There's a bunch of secular growers, as we would call them in the US, that are fairly economic resistant. And we saw that very much play out during the pandemic. Now, the risk there is that rates have to go even higher than they are today, not our base case, but a risk case. And that would really hit especially technology stocks, as we saw in the first quarter of this year. But where we sit today, US stocks especially, we like. Now we're underweight the rest of the world and we're neutral equities overall, but US equities we think still are worth having an overweight too. So if we go to the next slide, valuations, a bunch of metrics here across a bunch of different ways: price to earnings, price to forward earnings, price to book, cash flow, dividend yield. We focus on the price to earnings there on the upper chart. And what I would say there is, one, that price to earnings ratios in the US are not maybe as stretched as people think. It's within the normal historical range there. And while certainly above median, again, this is the same as with high yield, the index has really shifted, where technology is about 40% of the index. It was only about, say, 5% back in the early 80s. And as a result, if you have a higher allocation or a higher composition of your index that's in higher valuation sectors, that average should go up. Just like as I was talking about with high yield, the average credit spread should be lower because the difference there. So between that and what is still a very or a relatively low interest rate environment, certainly versus the history that we show here, we don't think US valuations are too extended versus themselves. Now, versus, say, developed ex-US equities and emerging, yes, more so. You can see that both DevX and emerging are at or below their long-term averages. And maybe longer term, that'll come into play, but certainly shorter term, we think they're cheap for a reason, and we still prefer US over non-US markets. Go to the next slide here. I'm going to go through these fairly quickly, but just a few points to make on all of these. So this gets to that issue of valuations. Over a 1-year period, not a lot of predictive power from valuations. Over a 10-year period on the far right there, much more. So when we think about valuations, that's very much how we think about it. So I wanted to put that slide in here. And if we go to the next slide, I think there's 3 random slides here that I just wanted to put in. Market corrections. We had a 10% correction. This slide's a little dated. So if you look at the bottom there, the current period trading weeks without a 5 or 10% correction, that has been reset. It's at 0. But the point I want to make on this slide is 5% corrections happen once every 10 weeks. So call it 5 times a year. 10% corrections happen every 35 weeks, so 1 to 2 times a year. So it's understandable that we get concerned about what we've seen so far this year. We're down about 10%, maybe a little bit more, but just know that this is not uncommon. Now, 20% corrections are a little more rare. And as you can see here, we're about 102 weeks into that the last 20% correction was, of course, during the pandemic. The next 2 slides, real quick. They're here just because I thought you might find interest in them. I won't talk to them too much, but this is looking at volatility in the markets from a little bit different lens. The year on the bottom there, the year declines, and then what ended up happening for the year. So you can see that every year the markets go down at least a little bit, and sometimes double, or usually it's double digits, but a lot of times they end the year positive. So that's an important point to remember. And then you can see 2017 there. I mentioned that earlier, how abnormally non-volatile or calm the markets were, even when the Fed was in fact reducing interest or reducing accommodation. So just wanted to point that out also. And the next page here, I know I'm coming up on time a little bit, but real quickly, 2 last slides, and there's a few other slides that I won't go through. They're more for your perusal. On strategic themes here, again, these are a little bit old, long in the tooth. We do these in August of each year, and so we're coming up on it again this year. But a lot of these themes we think will continue, and I'll just touch on a few real quickly. Reversion to mediocrity. We're not going to grow like we did coming out of the pandemic forever. We're going to go back to something that looks pretty much like what we saw before the pandemic. There's no reason to believe otherwise. We got the same debt problems, the same demographic problems, the same automation that can eventually bring inflation back down. And that's why the theme there of sticking to stagflation is that certainly in the near term, inflation has been a lot higher, but over the long term, there's a good chance that inflation will start to come back down once if they can break any price wage spiral, the automation starts kicking in again. There's still a lot of automation that can be done in this economy. And so we'll be reviewing our inflation views in the coming months and publishing our new document in August. But that is a longer term view that we have held. And then on the right there, just real quick, expectations for returns. I'm not going to go through this in a lot of detail. This is all covered in our capital market assumptions white paper. And also if you go to www.capitalmarketassumptions.com, that's all out there as well if you're interested in getting into more detail here. But let's move to the next page. So those return expectations then are combined with risk and correlation and creates that strategic asset allocation you see there. And then and that's a 5-year plus horizon. And then on a tactical horizon, which is a 1-year horizon, we make overweights and underweights. Now, this is on our global policy model. It's a middle of the road portfolio that we use to describe our views. Obviously, Darius and Marty and crew take these views where applicable and bring them down to your portfolios. That's why they get paid the big bucks. But for us, we just want to give them a starting point. So 3 trades that are on in the portfolio right now. One is that overweight to US, underweight to developed and emerging, but equal weight on equities overall. I think I went through that already. Also, I think we have a high yield overweight and an underweight to investment grade. That's very much to capture that idea that we'd rather take on credit risk than interest rate risk in this environment. Although, as I mentioned, we're getting close to where we think investment grade may be a bigger buy opportunity, but you'll know that you'll be the first to know when our policy meetings occur over the next few months, if we in fact do start to shift that. And then finally, what's been a really nice allocation to the portfolio, both strategically and an overweight tactically, is natural resources. It's an asset class that's up 20% for obvious reasons, the inflation and the energy impact from the war. And it's up 20% when the rest of the markets are down to 10. So, we've had to defend natural resources for years and years and years because it's underperformed. And we've always said, well, we're willing to take some underperformance there if the markets are doing what they're doing, and what they've been doing over the last 5 years is up 18% annually through a little bit lower than that now, but through last year anyway. So that underperformance didn't bother us as much. It would bother us if it wasn't performing well in this inflationary environment that we have. And the good news is that it's validated itself, and it's been a really nice performer and has really provided some offsetting positive returns in the portfolio versus the rest of the portfolio, even fixed income that's been down year to date. So those are the 3 trades in the portfolio. Now, what's on the next few pages here, if you go to the next one, I'm not going to go through the ones after. Oh, I'm sorry. We did throw in the alternatives and hedge funds real quick. This is just a slide showing the return premium we think we can get out of private equity and private credit. This is historically based, and if anything, the managers have been able to far outpace these types of return premiums. So certainly alternatives, to the extent illiquidity can be taken on the portfolio, makes a ton of sense. And we think it continues to make a lot of sense, especially as the world kind of migrates a little bit away from public markets and more to private markets. It's good to be invested there to the extent you can take on the liquidity. And then the next slide here will show hedge funds. And this is out of our capital market assumptions piece from last year. But what's really interesting here is obviously hedge funds have been coming a little bit under fire during the 2010s. Where the alpha just was not there. It was barely positive at all. And so what are we paying for, right? If we're not getting that. And it certainly wasn't like it was in the 90s and in the 2000s. But if you look so far this decade, it's really increased. And it's really interesting to see the correlation between the connection between the amount of dispersion in the markets. So some stocks up a lot, some stocks not up as much, some stocks down, et cetera, versus what we saw in 2010. So there wasn't a lot. So there wasn't a lot for the hedge funds to take advantage of. So now that we do have that dispersion, it's nice to see that alpha number has come back, and hopefully that's a sign of things to come for anyone that's invested in hedge funds. And again, our team will try to do as best as we can to identify those managers that can provide that alpha. And then finally, I think this will be the last slide. Yeah, so we wanted to make the case for all the asset classes we provide. And Peter Lynch once famously said, you shouldn't invest in anything you can't illustrate with a crayon. Marketing doesn't let us show slides with crayon written all over it. So the next best thing is simple bullets for all these asset classes. In the interest of time, I think I'm already over time by a bit. I'm not going to go through all of these, but it's pretty self-explanatory. And again, we just really wanted to make sure that our clients know why we invest into the things we do, supporting asset classes like real estate, listed infrastructure, natural resources, high yield, and then on the real risk control side of things, inflation protected securities and tips. So I'll stop there. Apologies for going a little bit over what you wanted me to do, but happy to answer any questions.
It doesn't look like we have any questions at the moment, but if we want to wait just a minute to see if anyone has any questions, that may be helpful.
Yeah, and again, these are, we've got one pagers for all these as well. So to the extent you're wondering why we invest in these asset classes, we hopefully provide you clear and concise reasons on these slides.
Hey, Dan, now while we wait for questions, natural resources, you touched on that in terms of that's been a great exposure in a very tough environment for returns elsewhere in the portfolio. Maybe you want to just spend a quick minute on this slide and just talk about the characteristics of why that is.
Yeah, so you can see there inflation, during times of inflation, natural resources does quite well. If you look at that lower left chart there. Now, equities aren't a bad inflation protector, by the way. To the extent companies have pricing power, they're able to push that inflation through the end consumer, and markets can still do well. And we've seen that, right? Up until recently, anyway. Last year, markets did very well in an inflationary environment. But natural resources do even better. And you can see there, we divided between periods of high inflation and low inflation, or normal inflation, I guess we call it. And you can see that natural resources covers inflation a greater percent of time than any other asset class. That's just is the asset class outperforming inflation. But then at the bottom, they're more interesting, again, back to high inflation and low inflation or normal inflation, is you can see that performance out of natural resources. You don't get a lot during normal inflation, but it pays for itself in periods like this. And the last thing on the slide on the right there is we get a lot of questions about a futures-based approach or an equity-based approach. So futures-based is investing in the underlying futures contracts and then flipping out of that contract to the next contract so that you don't take delivery and you got a bunch of oil barrels showing up at your doorstep. And that's, by the way, one of the issues with futures-based. It creates challenges because of that fact that you're not a natural buyer. Royal we is not a natural buyer of this stuff. It's just there to get the exposures. We think a better way to do it is through equity based. So we buy those companies that are really close to actually pulling whatever it is out of the ground, whether it be oil, industrial metals, agriculture, through fertilizer, or where we get the exposure there would be through like fertilizer companies, et cetera. And what you see there on the right is the proof point of doing it this way. On 3-year rolling periods, the amount of time that an equity-based approach has outperformed a futures-based is something like 95% of the time. The way to read that chart, by the way, is so on the bottom horizontal axis is the return of futures-based products or the futures-based index, and then on the vertical is equity. We got that 45-degree line in there such that anytime the dots are above that line, it means that an equity-based approach has outperformed over that 3-year period. And again, it's something like 95% of the time that is the case. So we go with the odds there. And this year, candidly, futures-based has outperformed, but over longer periods of time, we think an equity-based approach makes a lot of sense.
And then on that futures-based, it's not uncommon, right? When you have a really sharp movement in the underlying commodity, the futures contract's just going to move faster than the underlying equity component will catch up over time. So while the equity linked resources are underperforming, it's not unexpected in this environment.
That's exactly right. Yep. Markets, the commodity does what it does. The markets kind of smooth that out. The equity markets kind of smooth that out, understanding that oil will go up, oil will go down. And so, yeah, you get a bit of a smoother ride in situations like this. And you've seen that this quarter as well, where commodities futures base is up more, but you've also seen a lot more choppiness there, where it goes up 3%, some days down 3%. Natural resources is a volatile asset class as well. Not to sugarcoat that, but it's less. It can be less volatile than what you get in the futures markets.
All right. Well, thanks, Dan. Hopefully, you get time for the rest. And then, any other questions, Matt?
Yes, we do have 2 questions in the chat. Do you anticipate any changes to any fiscal policy in order to ease any inflation pressures?
No, the impact of inflation on fiscal policy has been that Build Back Better is effectively dead. I think Senator Manchin out of West Virginia put the final nail in that coffin a few weeks ago, where he said that he's looking to work in a more bipartisan way to do something, if they do anything, do something maybe a little bit smaller and certainly not before the midterms. So if anything, the fiscal policy has been a reaction to the inflation, and that was one of the big things that really prevented anything from happening again, along with, of course, a lot of, frankly, political dysfunction in Washington, but which is where I am right now, ironically. But so maybe I'll let them know that they need to figure their stuff out.
Okay, and then has Northern seen anything in regards to the chip shortage and how that resolution is sort of playing out?
Yeah, so we're lucky that we have a fully dedicated equity research team, and Deb Cook is our tech analyst, and she's been keeping us up to speed on that. It is I would describe it as a continued challenge, but getting slowly better. And obviously we're seeing a lot of, and this gets to one of our themes actually from that previous page, which is seeking tech independence. We're going to see a lot of fabrication plants built in the US. We're already seeing it. There's a big one in Ohio, a few others, I believe, maybe one in Arizona, I want to say. So we're going to see that start to resolve itself, but it's going to take time. Those plants don't, pop up overnight, but it's a slow thing. It's still an issue, but they are finding ways to work around it. And interestingly, I thought it was interesting, Tesla, for instance, when they came out, they were able to do a lot better with that shortage because they had more engineering prowess and had a better ability to figure out where they could use other chips in substitution. So I thought that was really interesting. And as a result, Tesla had quite a good quarter, actually. So, companies are figuring out ways to get around this, as you would expect.
And then if you could just discuss or sort of highlight tips.
Yeah, so tips, the thing about tips you got to remember is it's not just, oh, inflation's high, so it's going to do well. It's what is priced into the markets. Yeah, and thank you for going back to that slide. If inflation is, so right now break evens, right, are pretty elevated. So they're pricing in inflation. If we actually think that inflation is going to start coming in lower than what's priced into the markets, then tips is not something you want to buy. In other words, inflation can still be at 5%, say, over the next year. But if the markets thought it was going to be at 6%, then tips are going to underperform similar duration treasuries. The reason why they did so well this first quarter is because, and over the last year, frankly, is because inflation expectations far outpaced what was priced in. So we sit strategically right now because we do think we're getting sort of to a top of inflation, but there's a lot of uncertainty out there. So we think holding a strategic position makes a lot of sense, but we don't want to be tactically overweight or underweight right now.
Okay, I think that's it for the questions.
Well,
Thank you, Dan,
so
for your
much.
time.
I really appreciate it.
Great. Thanks a lot, Dan. Hey, Marty, why don't we move over to you, and we'll take a look at the portfolio, and I'll get the slides teed up.
Sure. Yeah. Thanks, Darius. This is probably a good spot to just take a step back and say, how have we done Northern Trust to help out the DuPage Foundation? So just very quickly snapshot. And we've had a really long relationship with the foundation. We've had a good long-term return average over 9% going back to the inception of our relationship, outperforming in 9 out of 13 years going back. So it's a really good long-term track record. The foundation has a spending rate of about 4.5%. And one of the ways that we add value to our clients, nonprofit clients, for those that aren't as familiar with our foundation institutional advisory group, is providing a long-term strategic plan for the organizations to protect the spending power, or in this case, the grant-making ability of DuPage Foundation to make grants in local community. And so we've done that for the DuPage Foundation. I think maybe the next page might show. Yeah, exactly. So over time, the portfolio for DuPage has grown considerably. Going back to the inception was around $12 million. We've grown that to over $56 million through the partnership we've had with the DuPage Foundation. And so that, again, a really good, strong relationship that we've had with DuPage. So then kind of jumping forward to a portfolio review, and I won't go through this page kind of in detail. Dan did a good job of covering kind of our strategic positioning. And then to put a little context around this page was the current asset allocation of the portfolio. Another way that we add value to our clients' portfolios is setting that strategic plan. So if you look at the middle of this page, we have an IPS target. That is the long-term strategic goal that we've set for the DuPage Foundation to protect their spending power. It's for 44% equities, 29% fixed income, and 25% alternatives. And then you'll see on the left-hand side our current allocation, and on the right, kind of the IPS range, so the range of targets that we have around that IPS target. So if you look at our current allocation, you're very much as advertised. We're overweight US equities, underweight equities outside the US, including both developed, international, and emerging markets. Continue to have an underweight to core investment grade fixed income in the US. Equal weight to TIPS, or inflation protected fixed income, and maintaining a small overweight to our high yield bonds, which is, as Dan mentioned, a high conviction asset class for us as we sit here today. On the alternative space, we do have a very well diversified allocation to alternatives. So alternatives to us, the way we explain them, includes both real estate, infrastructure, commodities, hedge funds, and private equity. We've had a really good, successful track record of having hedge fund and private equity investments in the DuPage Foundation portfolio. You can see here that we're a little bit underweight our 15% allocation, but we're going to be adding to that as we kind of go through time. So getting to the actual performance in the portfolio at a very high level from an asset class perspective. As you look year to date, it's our first quarter call, so we'll talk a little bit about year to date, and we'll talk about kind of what's happened in the past year. A really difficult quarter for equity markets, with the total equities in the portfolio down a little bit over 7% quarter to date. And then as you look at kind of the breakdown in the equity side between US equities and international equities, we had about -5% returns on our large cap US equity returns. And another way that we add value to our client portfolios is finding complementary, active, and engineered strategies to couple with the low cost passive allocations that we get to get the market returns in the portfolios. So a couple of examples of that in the large cap section is we have about a 6% allocation to our factor tilt portfolio, which just tends to skew a little bit small cap, a little bit value in an engineered kind of portfolio. A little bit more of a difficult environment historically for that small cap and value portfolio, but this year is really showing you why we like that to have the exposures to that into the portfolio. So the returns on that tilt portfolio only down 377 basis points versus the ACWI benchmark down 536. So adding value there. Yeah, and then we have a couple of active managers in the large cap side. Our Coho Partners is a value strategy. Again, value is not done very well over the past few years. But the returns this year, quarter to date through the first quarter, really showing why we like to have a long-term allocation to a manager like Coho. The returns in the Coho portfolio down less than 1% in an environment where equity returns are down over 5%. I'll also point out we do have an allocation to a growth manager, Poland Capital, a large cap growth. This is kind of the opposite relationship that we've seen with the Coho Partners on the value side. So growth over the past several years has done extremely well. In Poland Capital over the last 3 years has generated over 120 basis points of alpha versus their growth benchmark. Over the past 5 years, they've generated almost 5% excess returns versus the growth benchmark. But as we've seen so far through the first quarter of this year, growth has struggled for all the reasons that Dan talked about, with the increase in interest rates kind of putting pressure on those longer duration growth strategies. I'll move down to the international developed portion of the portfolio. We do have a large allocation to an index portfolio on the international developed side. Those returns were also a little bit behind benchmark in the first quarter. And also, I also point out that WCM International Large Cap Growth, similar story that we saw with Poland. Great long-term track record for WCM. That's why we like to have them in the portfolio as a complementary option. They beat their growth benchmark internationally by almost 9% over both the last 3 years and the last 5 years. And again, you can see the first quarter performance, they've given some of that back, but we we are confident that in their long-term track record, so that's why we have them in the portfolio. So we go to the next page, talk a little bit about fixed income. In fixed income, when interest rates are going up, it's important to have an underweight to duration. So as the interest rates go up, the underperformance is a little bit less. That is played out in the DuPage Foundation portfolio. So our underweight duration, having an allocation to our active fixed income manager DoubleLine. They have an underweight duration position. So having that coupled with our allocation to the Ag Core benchmark has provided almost 1% of excess returns versus the Ag benchmark year to date. Very quickly on the alternative space, you can show here exactly what's happened, and Dan talked about this. On the commodity side, almost 20% returns year to date in an environment where returns are negative for both equities and fixed income. Having that 5% allocation to the upstream natural resources ETF has been really beneficial to the portfolio. Also has a really good track record over the past year. So returns on the commodity side up almost 35% over the past year. Again, providing a good return, alternative return stream for the DuPage Foundation portfolio. Similar story on real estate and infrastructure. It's been a good place to hedge some of the inflation pressures that we've seen in our client portfolios. So returns over the past year in real estate up almost 11%, and infrastructure up similarly, almost 11% year to date over the past year. Real quickly on kind of the hedge funds and private equity, the hedge fund returns year to date down 1%. So hedge funds really doing what we expect them to do, hedging some of the volatility we've seen in both the fixed income and equity markets, with equities and fixed income down over 5%, having that negative 1% performance in hedge funds year to date has provided a nice cushion to the performance in the portfolio. And then finally, on the private equity side, this is an allocation we've been building up and maintaining for the DuPage Foundation going back many years. And you can see on the performance side, the benefits that we've seen from that. So over the past year, private equity returns in the sleeve we have for DuPage Foundation up over 50%, which is a great number. And even if you look out over the past 3 to 5 years, returns over 20, almost 30% over the past 3 years. So this is the first time we've done one of these calls. So we thought it'd be helpful to kind of put in some topical, to talk a little bit about kind of a topical event. So we're going to talk about private equity today, why we like and advocate for private equity in our client portfolios. So if you look at kind of the capital markets assumptions, and Dan did a good job of introducing those to everybody. As we look at private equity and private credit as an asset class, we think there are outsized opportunities versus kind of the subdued low single digit to mid single digit returns that we see from fixed income and global equities. So that getting that 6.5–7% return from private equity, private credit provides kind of opportunities outside of the liquid benchmarks that we can get into client portfolios. So the next page really does a good job of kind of looking at our 10-year projections. So as we look out over the next 10 years, we anticipate equity returns in the US and globally to be somewhere around the upper 5, almost 6%. As we look at private equity as an asset class, our expectation for those returns are almost 9%. So what you're seeing there is really the illiquidity premium that is involved with investing in the non-liquid assets. So, buying and selling in private markets, there's a premium to doing that. And that's what we're showing here. If you look back over the past 10 years, which is the middle chart here, you have received private equity-like returns from the US equity market. So we've had 15% returns on average in the S&P 500 over the past 10 years, almost identical to what we've seen from our private equity benchmark securities. So as we look forward, you have to kind of put into perspective, is the next 10 years going to look like the middle chart, where equity returns were similar to private equity? Or is it going to look more like what we saw in the 2001 to 2011 period, which is on the far right? If you look at that, the equity markets returns both in the US and globally, so looking at a global benchmark here, we're very much like what our capital markets assumptions are showing, low single digit to mid single digit returns. Still, even in that environment, we received an almost 3% premium on the illiquid assets and the private equity side. So that's why, as we sit here today with our expectations for more subdued asset returns in both fixed income and equity markets, that we're advocating to continue to put assets to work to try to get a premium over our liquid benchmarks in the private equity securities.
We've got about 5 minutes left, so maybe it's a good time to pause and see if folks have any questions for us. And while we're waiting, just another reminder from what I said at the very outset, we want to do this on a quarterly basis, but we wanted to make sure it's a good use of your time. So please do reach back out, give us feedback, whether it's the topics, the content, too much detail, not enough detail. All feedback is welcome, and we'll definitely take that into account when we schedule the call for the next quarter.
So Darius, I don't see any questions coming in, so maybe we'll just end a few minutes early. As we wrap up, I want to thank both Darius, you and Marty for joining us this morning, and if you could pass our gratitude on to Dan as well, much appreciated. I also want to thank Matt for organizing this webinar as well as manning our Q&A and chat session, much appreciated. For the participants, hope you enjoy the webinar. Thank you again for joining us, and hope you have a great rest of your day.
Thank you all.
Thanks, everyone.
Thanks, everyone.